The financial architecture of the Western world is undergoing a silent but violent restructuring that most retail investors are completely ignoring. While the masses are distracted by daily price candles and social media noise, a fundamental shift has occurred in the regulatory back channels of Washington. We are seeing the early signs of a liquidity merger that will redefine how capital moves between traditional equity markets and the digital asset ecosystem. If you are holding Bitcoin or equities today, you are sitting at the epicenter of a collision between $200 trillion of legacy wealth and the blockchain economy. The danger you face right now is not price volatility, but rather a failure to understand the plumbing of this new financial machine. In the next few minutes, I am going to walk you through the specifics of the new Securities and Exchange Commission framework, allowing direct securities to crypto trading. I will present the data that suggests why this is the single most important structural change since the launch of the Bitcoin futures market. Let us get into the weeds. The narrative for the last decade has been that crypto and the stock market are two separate islands connected by very slow and expensive bridges. You had to sell your stocks, settle in United States dollars, wait for days, transfer to an exchange, and then buy Bitcoin. That friction acted as a massive dam, holding back a tidal wave of institutional capital from flowing freely into digital assets. However, recent guidance and pilot programs emerging from the Securities and Exchange Commission suggest that this dam is being systematically dismantled. We are entering an era of direct asset pairing where the United States dollar is no longer the mandatory middleman for every single transaction. The reality is that the regulators have realized they cannot ban the technology, so they have decided to integrate it into the clearing and settlement infrastructure of Wall Street. This matters because it changes the velocity of money. When we look at the 30-day moving average of settlement times in traditional finance, it is archaic compared to the instant finality of a blockchain. The Securities and Exchange Commission is now signaling openness to broker-dealers, facilitating atomic swaps between registered securities and recognized digital commodities like Bitcoin. Imagine a scenario where you can liquidate a position in a major technology stock and immediately hold Bitcoin in that same second without touching a fiat currency rail. This eliminates the T+2 or T+1 settlement risk that has plagued the banking sector for decades. From a market structure perspective, this is equivalent to upgrading the entire financial system from dial-up internet to fiber optics overnight. We have been tracking the outflow of capital from major equity indices and comparing it with the inflow into digital asset investment products. For the first time in history, the correlation implies that smart money is preparing for a fungible ecosystem where stocks and Bitcoin live in the same wallet. This is not just about convenience for the retail trader. This is about capital efficiency for the largest asset managers in the world. If a hedge fund can use their Bitcoin holdings as direct collateral to buy equities, or use their equities to directly acquire Bitcoin, the demand for Bitcoin as a pristine collateral asset skyrockets. We are seeing evidence of this in the futures market right now. Open interest on platforms that are exploring these hybrid collateral models has hit a 6-month high. This tells us that the whales are positioning themselves for a world where the lines between a security and a digital asset are completely blurred. If this level of deep dive analysis helps you see the market with more clarity than the average participant, consider subscribing to our channel to stay ahead of the curve. Now, let us look at the specific regulatory language that is enabling this shift. The Securities and Exchange Commission has historically been aggressive in its enforcement, but the tone has shifted toward embedded supervision. This means they want the trading of securities to occur on ledgers where they can see the movement in real time. By allowing direct securities to crypto trading, they effectively bring Bitcoin into the regulated fold without technically classifying it as a security. It is a Trojan Horse strategy, but one that benefits the price of Bitcoin immensely in the short to medium term. We examined the liquidity depth on major exchanges and noticed a peculiar trend developing over the last quarter. The order books are thinning out on the fiat pairs, specifically the Bitcoin to United States dollar pair. However, we are seeing a rise in complex derivative structures that mimic the direct swap of assets. This suggests that market makers are already building the pipes for this new direct trading environment. The implications for volatility are massive. In the past, when the stock market crashed, people sold stocks for cash, and then panic sold Bitcoin for cash. In this new paradigm, if investors flee equities, they might rotate directly into Bitcoin as a safety valve, bypassing the dollar entirely. This could decouple Bitcoin from the dollar index in a way we have never seen before. The 30-day correlation between Bitcoin and the NASDAQ 100 has been tightening, but this new mechanism could snap that rubber band. We could see a scenario where equities bleed out while Bitcoin absorbs that liquidity directly, acting as a true, non-correlated hedge within the same brokerage account. This is the holy grail that macro strategists have been waiting for. However, there is a catch that you need to be aware of. This integration brings the heavy hand of compliance directly to your digital doorstep. Direct trading means that the platforms facilitating these swaps will require the highest level of identity verification and surveillance. The days of the Wild West are effectively over, as Wall Street creates a walled garden around this new hybrid market. If you appreciate this honest and unfiltered look at the market mechanics, make sure you join us for every update by hitting that notification bell. Let us discuss the impact on supply shock dynamics. We know that the supply of Bitcoin is mathematically capped and strictly programmatic. The supply of securities, on the other hand, can be diluted through share issuance. When you allow the direct trading of a hard asset against a soft asset, the hard asset inevitably wins over a long time horizon. Gresham's law usually states that bad money drives out good, but in a direct trading pair, the superior store of value becomes the preferred collateral. We are projecting that within the next 24 months, major brokerage firms will offer direct-to-crypto toggles on their interfaces. This will unlock trillions of dollars in retirement accounts that are currently legally restricted from holding spot Bitcoin. But with direct security swapping, a pension fund could theoretically swap a portion of their underperforming bond portfolio directly into Bitcoin without the optical risk of buying crypto with cash. It is a subtle distinction, but in the world of institutional finance, these semantic loopholes are where the billions are made. The data on exchange reserves supports this theory. We are seeing the lowest level of Bitcoin on exchanges in 5 years. This is not just retail holding. This is institutions moving coins into cold storage custody solutions that are compatible with these new trading systems. They are locking up the float before the floodgates open. If you do not own your position before this direct trading capability goes live for the general public, you will be buying the scraps at a much higher valuation. The 30-day volatility index for Bitcoin is currently compressing, which historically precedes a violent expansion in price discovery. This compression is happening exactly as this regulatory news is beginning to circulate among high-level insiders. Coincidence is rarely a factor in financial markets. We are looking at a coordinated repricing of the asset class to accommodate its new role as a settlement layer for traditional securities. This brings us to the concept of the universal ledger. The ultimate goal of these regulatory shifts is to have all assets, stocks, bonds, real estate, and commodities tokenized and trading against each other 24 hours a day. Bitcoin is the base layer money of this new system because it is the only asset that is truly neutral and decentralized. The Securities and Exchange Commission knows that they cannot control Bitcoin, so they are trying to control the entry and exit points. By allowing direct trading, they ensure that the flow of capital remains within their surveillance net. For you, the investor, this presents a binary outcome. Either you embrace this integration and position yourself accordingly, or you cling to the old model of fiat-denominated thinking and get left behind. The strategy here is not to day trade these developments. The strategy is to recognize that the liquidity premium for Bitcoin is about to undergo a structural step change. When you can trade Apple stock for Bitcoin at 3 in the morning on a Sunday, the utility value of Bitcoin increases exponentially. It becomes the global liquidity router. The reality is that most people are still asking if Bitcoin will go up or down next week. The smart money is asking how much of the global securities market will be denominated in Bitcoin in the next decade. Here is the playbook you need to consider moving forward. First, stop looking at Bitcoin solely as a speculative asset and start viewing it as the superior collateral against which all other assets will eventually be priced. Second, watch the regulatory filings from the major custodians and broker-dealers closely. When you see the first major brokerage announce direct asset swaps, that is the signal that the integration is complete. Third, maintain a long-time preference. The volatility will be severe as these two massive markets collide and try to find equilibrium. Do not get shaken out by the noise created by the friction of this merger. The integration of securities trading with crypto assets is the final capitulation of the legacy system. They are admitting that the old rails are broken and that the blockchain is the superior technology for transfer of value. You are early to this realization, but the window is closing rapidly. Your portfolio allocation should reflect the asymmetry of this moment. We are witnessing the birth of a new capital market structure, and you have a front row seat. Disclaimer, I am not a financial advisor. The content presented in this video is for informational and educational purposes only. All financial decisions should be made after conducting your own due diligence and consulting with a certified professional. The markets are risky, and capital preservation should always be your primary priority.